everybody, and welcome to this August 10th edition of our Economic Impact short video. As usual, I'm joined by our chief economist, Mr. Stéfane Marion. Hello, Stéfane.
Hi, Martin. Happy wedding anniversary.
Thank you. 25 years, going strong.
Great.
So, as usual, we will start by looking at the impact of this pandemic. Stéfane, mixed signals going on.
Yeah, it might be frustrating to follow, Martin, and it's definitely impacting financial markets in recent weeks. We can see on the slide that even countries that are highly vaccinated have seen a pickup in new cases. Israel now above the UK, and the US obviously less vaccinated, but trending up with the other two. So some uncertainty on the pandemic front still with us. But as we said last month, Martin, at this juncture, the encouraging news is despite the increase in new cases, hospitalization rates are still well below what we saw last spring. So it does suggest that, yes, there might be an impact, but it is unlikely to lead to economic shutdowns around the world. But yes, we have to watch the variants for sure.
Absolutely. And this leads to a direct impact on economic surprises turning negative.
Well, yeah, the variants have brought uncertainty in the markets, and we've seen that, the economic data has been coming somewhat below expectations, particularly in the US and China, where the variant is also having an impact, the COVID variant, that is. So slightly below expectations, Martin, but I just want to reassure everyone here, negative economic surprise does not mean negative growth. Right now, at this juncture, we're talking about growth that is slightly under expectation, but it's still positive growth. So we might need to ratchet down our expectations for profits down in the coming months, but it's unlikely to be negative growth. So at least that's the good news. But yes, it's having an impact right now.
And to illustrate your point, we should look at manufacturing data for July is still super strong.
Yeah, so it's not because you have negative surprise that you have negative growth. Case in point, Martin, you're absolutely right. When you look at the July performance, global manufacturing activity, there's still great momentum at this juncture. So it does suggest that the growth outlook remains supportive for manufacturing, of course, but also for commodity prices that have been hit a little bit harder in recent weeks on COVID fears, but so far so good in terms of the level of activity.
And we've talked about it before, but I really like this slide. The rebuilding of inventories and delays it's staggering.
Yeah, so supporting increase in industrial output in the coming months, Martin, will be obviously increased demand from consumers, but at the same time, the need to rebuild very depressed inventories. And customer inventories right now, when you talk to U.S. manufacturers, they are the most depressed ever. And at the same time, the supply chain issues created by COVID means that the delays to get your goods to market are very, very long. So the combination of both sectors, Martin believes it means, yes, more production in the months ahead, but inflation that is likely to be somewhat stickier than what the central banks are currently assuming in their respective forecasts.
Anything to do with the infrastructure program of President Biden?
Well, you could argue that from the U.S. perspective, the infrastructure program is clearly a positive for the manufacturing sector in the U.S., but I think by and large globally. So yes, with fiscal support being deployed in the U.S., but also in other regions around the world, means that we get this inventory rebuilding cycle that could be with us for a few quarters, Martin. So it's positive news for growth down the road.
And Stéfane, our listeners constantly ask us about inflation. What's the most recent reading on that front?
Well, inflation expectations I would say were higher in March. They've come down a little bit through the month of August or to the month of July, and now they're starting to rise again. But we're still below the levels that prevailed back in March. I would say that, Martin, that right now investors are in wait-and-see mode, depending on what happens to the COVID situation. And the Biden stimulus must be voted. It should happen this week, maybe today even. We'll see about that. But yes, it's wait-and-see for investors on inflation expectations, but I doubt very much that it's going to collapse, Martin. It should remain above 2% for the next few quarters.
And meanwhile, the stock market around the world, we're seeing new highs.
Well, yeah, if you have your inflation expectations relatively stable, I mean, that's maybe some pricing power for corporations. On top of that, you have decent growth. as you saw in the manufacturing data, which means that the stock market, despite the uncertainty related to the pandemic, hit new all-time high in August. So it's every month it seems like we're meeting and we're seeing a new high on the stock market, we'll see for the months ahead. But clearly, investors have been, or people that invest in the stock market are seeing some optimism for the next few months.
And in order to support this, we need valuation and we need profits. How is it looking?
Yeah, so the question is the increase in the stock market artificial, purely driven by an increase in valuation, so higher PE ratios? To a certain extent, yes, PEs are being kept high by interest rates that are very low. If you actually adjust interest rates for inflation, Martin, we're talking about the lowest rates on record for the U.S. economy. So yes, there is a component that is supportive to the stock market that is related to very low interest rates, but it's not just that, Martin. If you look at profits, it is very impressive, the rebound that we've seen in recent weeks. New all-time high for profits, that blue line in that slide, and even if you exclude the U.S., it's about the same story, Martin. So clearly, the stock market is not rising purely on speculation and depressed interest rates. There's also profits that are there.
Let's talk about employment. We had some strong numbers recently, especially for Canada.
Yeah, and you can't get you're not going to get better job growth if you don't get profits. So the fact that profits are rebounding right now translates into an improving jobs market both in the U.S. and Canada. I would say it's the case globally, Martin, but from a North American perspective, clearly some improvement there. The U.S. surprised on the upside for the month of July, but they're still 4% below the pre-COVID level. What is staggering, Martin, on this chart is to say that Canada continues to outpace the U.S. in jobs recovery. We're just 1.5% shy of our pre-COVID levels, so clearly a good outlook for domestic spending for Canada in the months ahead, and not so bad for the U.S. It's improving, but Canada is ahead of the U.S. Hence our view that the Bank of Canada will probably be hiking interest rates before the U.S.
And you found a little nugget of information that's really interesting about the U.S. Job market.
Well, one of the big question mark for the U.S., they're still 4% below pre-COVID levels, Martin, is that what happens when all these government programs that are there to support household income are phased out or eliminated in the months ahead. So there was a high degree of concern in recent weeks because of that. But, Martin, the data is being published right now shows that we now have a vacancy rate for jobs of 6.5%. So 6.5% of all jobs available in the U.S. are vacant right now. In the leisure and hospitality sector that was hard hit by COVID, we're talking about more than 10%. So the key message on this one, Martin, is that I'm not overly concerned about the end of government programs to the extent that people can just turn around without the government programs, turn around and get a job with these very high vacancy rates. There are more vacant jobs in the U.S. than people unemployed. You rarely see that.
So, as a conclusion, despite the end of those stimulus programs, there's still pretty good outlook for growth.
The cyclical backdrop is not bad, Martin. We have to watch. We can't be complacent. We have to watch the evolution of variants, and that's still a big unknown. But yes, there are cyclical factors that are quite supportive. For the stock market, another uncertainty in the weeks ahead might be if there is indeed good job creation, that will bring more uncertainty with respect to a potential tightening in U.S. monetary policy. So that might be a story for another day, but I would just say from a stock market perspective, the very strong gains that we've seen year to date in excess of 15% globally, it would be difficult to have a repeat for performance in the second half. So the uncertainty might come from the central banks in the months ahead.
So as a conclusion, things still look good, but we need to remain prudent. So thank you, Stéfane. Thank you for our listeners, friends, family, clients of the family of National Bank. Thank you for listening. Take some time off, and we will see each other again in September. Thank you.